Hi, today's my topic of the class is a format for the calculation of income from house property. So before starting that concept, I am going to recall the concept which I explained in the previous class, that is a classification of house property. So entire provisions related to the classification of a house property I have explained in the previous class. The types of house property, there are three categories: self-occupied property, let-out property and deemed let-out property. Under self-occupied property, the residential house or the building which self-occupied throughout the year considered as a self-occupied property, or the building or house partly vacant and partly self-occupied, then it is considered as self-occupied. Partly vacant of the house and partly self-occupied of the house, the building partly vacant and building partly self-occupied, then it is considered as a self-occupied property. Then unoccupied property throughout the year is also considered as a self-occupied property. The property which is not occupied by any person, either not used for residential or not used for let-out purpose, then such property considered as a self-occupied property. The next division, let-out. The property or the building which let out throughout the year for rent, then it is considered as a let-out property. The property or the building, the part of the year let out and part of the year vacant, then it is considered as a let out property. The part of the year let out and part of the year vacant, then it is considered as a let out. Then the building or the property part of the year self occupied and part of the year let out, then it is also considered as a let out property. The part of the year used as a self-occupied and part of the year used as a let-out, then considered as a let-out property. And part of the year self-occupied, part of the year let-out and part of the year vacant, then it is considered as a let-out property. So in these all three cases, the part of the year used for self-occupied and part of the year used for let-out and part of the year used as a vacant, then it is considered as a let-out property, not the part of the building. If the part of the building vacant and part of the building self-occupied, then it is considered as a self-occupied property. If the part of the building let out and part of the building is a self-occupied, it is calculated as per its ownership, means if it is as per its utilization. If it is part of the house used as a let out, then that part is considered as a let out property, and if the part of the house is self-occupied, then that is considered as a self-occupied property. So that is the second division, let out property. Then third one is a deemed to be let out. So that concept I have explained in the previous class. Again, just recall of the concept. As per the Income Tax Act 1961, SSC can use only two houses as a residential house and only two houses considered as a self-occupied property. If SSC is a owner of more than two houses for residential purpose, then only two houses is considered as a self-occupied property. Limitation for the self-occupied property is a two. If the SSC is the owner of more than, or if the SSC is using more than two houses for residential purpose, then only two houses is are considered as a self-occupied property and remaining houses considered as a let-out property. So that is called as a deemed let-out property. The third house, the other houses are considered as a deemed let-out property. Even practically they are using for residential purpose, but for the assessment purpose or as per the act, only two houses considered as a self-occupied property and other houses considered as a deemed let-out property. So that's the concept which I have explained in the previous class. My today's concept is format for calculation of income from house property and format for the calculation of income of let-out property as well as self-occupied property, or format for self-occupied property and let-out property. The format for let-out property and deemed let-out property is one and the same. There is no difference. Only difference in case of self-occupied property and let-out property. Let's begin with the first provision, annual municipal value. Annual municipal value means the value fixed by the municipal authority for a house or for a building, then it is called as an annual municipal value. Then fair rental value, the value fixed based on the value of nearby property, then it is called as a fair rental value. The value of the house property is fixed based on the value fetched by or value of house nearby house property, then it is called as a fair rental value. The next one is a standard rental value, the value of the house property fixed based on the Rent Control Act, then it is called as a standard rental value. With the help of these three values, you have to find out the expected rental value. This is the first stage, calculation of expected rental value. Annual municipal value or fair rental value, whichever is higher but not exceeding standard rental value, is expected rental value. So there is a provision for calculation of expected rental value that you have to find out. How? By comparing annual municipal value with fair rental value, whichever is higher but not exceeding the standard rental value. The limitation for expected rental value is a standard rental value. In another way, you have to compare the municipal value with the fair rental value, whichever is the highest, the higher of these two, municipal value or fair rental value, whichever is highest, then this higher value to be compared with the standard rental value, then whichever is lowest is considered as a expected rental value. Municipal value or fair rent, whichever is highest, the higher value, and this higher value to be compared with the standard rental value, and in that whichever is the lowest is called as expected rental value. So next is actual rent received for a let out term. If house let out for 12 months, then rent received is for 12 months. If it was let out for 9 months or 10 months, some part of the year, then you have to calculate rent received is for let out duration only. So actual rent received, then less unrealized rent. Unrealized rent, in simple words, the rent which could not be realized by the SSC, by the owner in the previous year, is called unrealized rent. There are a lot of provision related to unrealized rent. I will explain that concept in the coming video. So here unrealized rent means it is a rent which could not be realized in the previous year by the SSC or by the owner. If there is any unrealized rent related to this house of the previous year, then you have to deduct it from actual rent received. But there are some conditions to deduct the unrealized rent when you have to deduct. That I will explain in the coming classes. And another one, if the composite rent is given, the cost of amenities to be deducted from composite rent. If there is a composite rent, if instead of actual rent, if the composite rent is given, then what is composite rent? The rent which includes the cost of other facilities, other amenities, is called as a composite rent. The rent of the building which includes the cost of the other facilities also, then such rent is called as a composite rent. For example, the rent of the house is 10,000, and in that 10,000, the 1,000 is the cost of water supply, or 1,000 is the cost of electricity, and 1,000 is the cost of watchman provided to house. And if these costs are included in the rent of house property, then such rent is called as a composite rent. So while you are calculating the income of let out property, or while calculating the actual rent, you have to consider the rent of the building only. So in this example, you have to, from 10,000, you have to deduct 1,000 cost of water supply, and 1,000 cost of electricity, and 1,000 cost of watchman. So actual rent is a 7,000. So that rent is called as a composite rent. So whenever the rent of the building, rent of the house, or whenever rent includes the cost of the other amenities or the other facilities, then such rent is called as a composite rent. So that is three cases for the calculation of actual rent. Actual rent received, less unrealized rent if there is any unrealized rent of the previous year related to this house property. Then composite rent, if the composite rent is given, then you have to deduct the cost of amenities provided by the owner or SSC to the tenant. So in detail, I will explain about the unrealized rent and composite rent in the coming classes. So next one is after calculation of actual rent received, then you have to find out the gross annual value. There are two formulas or two equation or two provisions to find out the gross annual value. The first one is expected rental value or rent received, whichever is higher whenever there is no vacancy period. So you have to compare expected rental value with the actual rent received, and whichever is higher is considered as a gross annual value whenever there is no vacancy rent. If there is no vacancy period or if there is no vacancy period, then expected rent or rent received, whichever is highest, is a gross annual value. And what is a vacancy period? The term during which the house was vacant is called as a vacancy period. For example, in the previous year, from April to December, SSC used the house for let out purpose and house property used by the SSC for let out. In the month of December, at the end of the December, the house was vacated by the tenant, then thereafter it was not let out. So therefore, remaining 3 months, January, February, March, till the end of the March, the house was vacant. So therefore, that 3 months is called as a vacancy period. So if there is a vacancy, then it should not apply. If there is no vacancy period, then you have to compare expected rental value with the rent received. Whichever is the highest is a gross annual value whenever there is no vacancy period. It means it is let out throughout the year. If there is no vacancy period, then higher of expected rent or rent received, whichever is highest. Otherwise, if there is a vacancy period, then expected rental value is equal to gross annual value. Means if there is a vacancy period, then expected rental value itself is a gross annual value. There is no comparison of expected rent to rent received whenever there is vacancy period. If there is a vacancy period, then expected rental value is equal to gross annual value. So that is a two formula for a two provision for the gross annual value. So I repeat, the first one, expected rental value or rent received, whichever is higher if there is no vacancy period. If there is a vacancy period, then expected rental value or gross annual value, expected rental value is equal to gross annual value. If there is a vacancy period, means there is no comparison. Expected rental value itself is a gross annual value. Next is after calculation of gross annual value, then comes municipal tax paid by the owner. So that is, you have to deduct from gross annual value to find out net annual value less municipal tax paid by owner. So first point here, it must be paid. One, if it is a due, then it should not be deducted. If the municipal tax paid in the previous year only, you have to deduct paid, and it should be paid by the owner. If it is paid by tenant or tenant, then it is not deductible. So if it's one point is it should be paid, means if it is a due, then it is not deductible. And second point is it should be paid by the owner itself, SSA itself, not by the tenant. So that is about municipal tax paid. And municipal tax of any year, of previous year, of present year and of next year can be deducted from gross annual value if it was paid. Point is, it should be paid and it should be paid by the owner, and it may relate it to any year. So then you will get the net annual value, gross annual value minus municipal tax paid by the owner, then the balance is called as a net annual value. So that is a first part of format for first part of calculation of income or loss from let out property. The same format even for the deemed let out property. Let me explain the second part of format of let out property, that is deduction under section 24. In the first part, I have explained about how to calculate expected rental value, gross annual value, and net annual value. In the second part is related to deduction under section 24. There are two deduction. One is a standard deduction and another is interest on loan or interest on borrowed capital. These two deductions are applicable for let out property. The standard deduction is 30% on net annual value. Net annual value into 30% of let out property. The second one is a interest on loan or interest on borrowed capital. So here only the interest on loan comes, not the principal amount. So interest on loan is liable for deduction under section 24. The loan is borrowed either for the construction of the house or for the purchase of the house is liable for deduction. There are two deduction under interest on loan, or there are two parts. One is a 1/5 of pre-construction period interest and another is interest on loan in previous year. 1/5 of PCP interest means it's a loan amount into rate of interest into PCP by 12 into 1/5. So here the concept of PCP means pre-construction period, or pre-construction period means the period starting from the day of commencement of construction or the day of borrowing, whichever is later, and ending on 31st March immediately prior to the year of completion of construction. So that is called as a PCP. So here you have to compare the date on which the loan is borrowed and the date on which the construction begins, or the date on which the house borrowed and the date on which the construction completed. This, on the basis of these values, you have to find out the PCP, pre-construction period, that I will explain in detail in the coming video. There are separate concept related to pre-construction period. Even while solving the problems, you can easily understand about the pre-construction period. So it is a interest on loan paid before construction. It meaning says pre-construction period interest means the interest on loan paid before completion of the construction. So that is called as a pre-construction period. Now the question comes, how to find out that PCP or the pre-construction period, that I will explain in the coming classes or in the while solving the problems related to house property. So only one concept you have to remember, it is the interest paid before completion of the construction of house property, and it has to be paid in 5 equal annual installments. So that's why it is multiplied by 1/5. So 1/5 of pre-construction period interest is equal to loan amount into rate of interest into PCP by 12 into 1/5. And second one is interest on loan in previous year. The formula is outstanding loan into rate of interest. So outstanding loan into rate of outstanding loan in the beginning of the previous year, the loan due in the beginning of the previous year into rate of interest is called as the interest on loan in previous year. So these are the two deductions which comes under interest on loan, or which is related to interest on loan. So mainly two deduction under section 24, standard deduction and interest on loan. So after giving the deduction under section 24 from net annual value, the balance is called as a income from house property or loss from house property. So again, there are a lot of provisions related to interest on loan or interest on borrowed capital about the pre-construction period and about the interest on loan in previous year, that in detail I will explain in the coming classes. Here it is just from the format point of view I am explaining the concept, and there is no limitation for deduction under section 24 in the category of interest on loan for let out properties. No maximum limitation for deduction on interest on loan. So no maximum limit for the deduction. Other details I will explain in the coming classes. So that is about the deduction under section 24. So these all about the format of income from let out property, or these are the provision related to how to calculate income or loss of let out property. There are mainly two parts. One is a net annual value and another is a deduction under section 24. The first part is a net annual value. It includes three parts. One is expected rental value, and another is a gross annual value, and another is a net annual value. And second part is a deduction under section 24, the standard deduction and interest on loan. Then you will get the income or loss from house property. So that's all about the provisions for the calculation of income or loss from let out property. So there are a lot of provisions related to other concept like unrealized rent or composite rent, or in case of vacancy period, and even in case of interest on loan, the PCP, pre-construction period interest, that I'll explain in the coming classes. This is just explanation for the structure or the format for the calculation of income from house property. Thank you very much.